welcome to the Higher Education Access Corner. I'm your host, Tiffanie DeVan, and today's episode is all about student loans. Joining me for this discussion, I have two gentlemen who are no strangers to the podcast. I have Dan Wray and I have Will McGinley. Welcome back, guys, to the podcast.
Thank you for having us.
Thanks, Tiff. Always a pleasure.
Yep. And for those of you who may or may not remember, Dan and Will are part of our private student loan product, or what I call suites of, they're on the team. They're the account executives. They also were on episode 66. For those of you who didn't see it, or you just want a refresher, they were talking about covering the costs. How do you fill that gap? Things like that. So today, who better to have back to talk about student loans, because that is one of the ways to fill that gap. So Dan and Will, I think you always talk about combined experience, Dan, how long you've been together. I know, Dan, you're probably about 36, 37 years in the industry.
You are exactly on the money there,
Yeah.
Tiff. Yeah, that's right.
All right.
I'm approaching 17 years in the industry.
All right. So that combined, I would say for all of our listeners, you are in great hands. So let's jump in and get started. Let's talk about student loans. And, first let's kick off. Why are we even having discussion, or why is there a need to have a discussion talking about student loans?
Yeah.
Yeah.
What do you say, Will?
You mentioned, we had that previous podcast about covering the gap. So anytime that you're really looking to go to college, and I'll use my family as an example. I've got two teenage boys, and we're going to be looking at colleges pretty soon. But as a financial aid director for many years, I had this conversation a lot. Ultimately, schools have a certain pot of money that they can end up giving to you that's gift aid. And so that ends up helping cover your bottom line and trying to figure out what you have to pay out of pocket. But particularly in my case, as someone that's even tried to plan and save, I probably still can't make that out of pocket expenditure year in and year out to cover their 4-year investment into their education. So when looking at the remaining gap, the remaining costs that I'm going to have to pay out of pocket, I'm probably going to have to finance some of that. And so looking at the loan market and figuring out what's right for me and my family, is it some sort of federal loan, a private education loan, some sort of combination, whatever it may be. That's really why we're talking about this today.
Yeah. I mean, it depends on whose numbers you believe, but somewhere between 2/3 and 3/4 of all students who go to some type of post-secondary school, whether it's a short program at a tech school or whether it's a veterinary program or whatever, there's a large percentage of students who need to borrow something to help them along the way. And it could be a good thing too. It's a good way to build credit for students who are, coming along. They don't maybe have a thick credit file. These borrowing for higher education is a great way to do that. Now, there's lots of reasons why we should be and we need to talk about loans for higher education.
Yeah, and looking at higher education in general, I truly believe it's an investment in your future. So, like with any other investment, sometimes it takes a monetary kind of investment into that. So you might have to borrow, like a house, a car, something like that. But I really feel like out of any investment you're going to be making, an investment in higher education in yourself is one worth making. Now, there's sometimes a stigma around borrowing that it's bad, or it's things like that. It's not necessarily bad if you do it wisely. And so if you're looking at, smart borrowing, meaning you borrow the amount that you in theory should be able to repay, which, we have a lot of different webinars and things that we're involved in. And we typically say, look at what your expected starting salary is.
Ooh.
And don't borrow more than your expected starting salary, because that way it's a manageable amount as you go into repayment. Where you hear these people are getting into trouble with their loans, it's when they borrow too much for what the career that they're trying to pursue. And that's something that we're really trying to, again, encourage smart borrowing, borrow what you can afford, and not much more.
Yeah, I always hate to put it that way, but my son, the industrial engineer, could afford to borrow a whole lot more for his education than his sister, who got into social work. And I hate to say it that way, I really do. because they both do important jobs. But this is real life that we talk about here on the podcast. And
Mhm.
I know Tiffany has probably heard this many times before, and I know she's said it many times before, is that not everybody can afford the same level of borrowing. It's just based on your career choice. So we got to look at that. It's real life. So not every student is
Yeah.
going to earn the same amount whenever they get out of school.
And I know before on the previous episode, episode 66, Dan, you also shared some resources for folks on how to search for the careers and their starting salaries and things like that. So for those of you who are tuning in, go back and listen to that episode, maybe even hear it again if you heard it the first time, because it is very important information. And then I also want to kind of pause just for a minute to make sure that everyone realizes, although this discussion is all about student loans, what Will and Dan are saying is very important. And remember, student loans are your last resort. So
Yes.
every year we want students to apply for all forms of free financial aid that you can get. That means completing your financial aid paperwork, your FAFSAs, your state grant applications, seeking out those scholarships. You want to exhaust all forms of free aid first, and then make your student loans your last resort. So this topic is all about, we're at the last resort part right now. So just for the listeners, I wanted you to remind them of, this is the last resort, not your first option. Where we're talking.
That's a great reminder, because that's where we are. We're at the do this as little as you possibly can section of the financial. You want to do with the grants and the free money, that's get as much of that as you
Yeah.
possibly can. We're at the get as little as you possibly need
Yep.
section of that puzzle.
Yep. And then the other part I say is, we're at a time of the year where it's exciting, right? Because at the end of the school year, if we're talking high school students, they're at graduations, prom season. They know what school they're going to go to. They've gotten the award packages and all of that, but they're also about to get a bill. So that bill is coming in. If those folks had the gap, it's kind of like, yep, this is that season we're approaching too. And then even for the student who's, home for break, but they're revving up to go back to school, they're going to get a bill as well. And where there is a gap, you know what, there's a way that you got to fill it. And we're talking student loans, but one thing we also know is not all student loans are created equal. So there are different types of student loans that are out there. So if you all can explain some of the differences, what types of student loans are out there, whether we're talking federal, private, and break it out for our listeners.
Yeah, I'll dive in on that one. Yeah, and boy, you mentioned bills. Every time I hear the word bills, I think of my old friend Linda Pasevich. She would say the last thing you want is bill panic. You don't want to be in bill panic mode, because when you're in bill panic mode, you have a tendency to not make the smartest decisions. It's best to make these calculations ahead of time and figure out what is going to be your best option. Well, when it comes to loans, your first stop is the Federal Direct Student Loan Program, and your FAFSA, your free application for federal student aid, that's your de facto application for that federal direct student loan. So you want to make sure you have your FAFSA on file for sure, and your state grant form on file, and you want to apply for scholarships. You want to apply for all that free money. But once you've done your FAFSA and you release your information to a bunch of schools, hopefully you release it to a bunch of schools, so you're going to get a lot of opinions on costs. Then your school is most likely going to package you up with some financial aid. And part of that package for a lot of students is going to be a federal direct student loan, whether subsidized, unsubsidized, or some combination of the two. And I'll let Will talk about maybe the next step, because there are annual limits on that federal direct student loan. And for a lot of folks, it's just not enough. And so they might have to go into something that we and the private student lending team, we do a whole hour webinar on the comparison of federal direct plus and private loans. And so maybe Will would take us through what those two types of loans are.
Yeah. So as Dan mentioned, so the federal government is a large lender, and so they have the direct sub and unsub loans, but then they have something called a parent plus loan or a graduate plus loan. So if you are an undergraduate seeking student, and you're looking at either getting a bachelor's degree or getting some sort of, a federally approved certificate or licensing, you could end up qualifying, as a dependent student for a Parent Plus loan. So what that is a loan that is in your parent's name. It is credit based. So they do look at a credit history, but it is looking for adverse credit. So what that means is that you don't have a bankruptcy, you don't have outstanding debts of more than about $2,000, there's nothing that the government kind of uses as an adverse kind of listing on your credit, which is a little bit different than our private industry. But with the Plus loan, just like with the student loans, you're going to end up having a fixed rate, that's based off of prime. So depending on what goes on with the federal government, that may raise or lower each year that you're taking a new one out. But it is kind of set right now, and it's set by Congress. And that's something that's kind of up for, annual kind of adjustments. But when looking at that, you also have fees. So the direct loans have like about a 1% fee. So whenever you're, figuring out your budget and those types of things, always make sure you subtract about 1%. So, each year, as a freshman, your loan limit is $5,500 for subsidized and unsubsidized combined. As a sophomore, $6,500. Junior and senior years, it's $7,500. So when looking at kind of your budget and what you're trying to figure out, you can always assume about 1% is going to be taken off the top, and then you have the remainder to kind of play with. If you have that need for additional financing, that's where the Plus loan kind of falls in with a lot of families. But if you have credit worthiness, and that's a big thing, is making sure, again, going to smart borrowing, borrowing what you can afford. I honestly think, and this is again where my family would kind of lean, is going in the private education loan realm. In private education loans, you're going to have fixed interest rates as well as variable. What that means, fixed means that when you take it out, it's going to be that interest rate forever, unless you refinance it. So it's going to, you take it out at 6%, it's going to stay 6% throughout your repayment. Variable means that there is something that is evaluated each and every year or quarter or month, whatever it is. And it's something that, depending on the terms of the loan, if that base rate ends up going up, that means your interest rate is going to go up. If that base rate goes down, that means your interest rate is going to go down. For a while, over the past 10, 15 years, variable rates weren't that bad because you saw interest rates dropping. But then all of a sudden, interest rates peaked back up. And so there's a little bit of a balloon where a lot of people got caught that had those variable rates. And that was a hard adjustment to get used to those new payments. So, like when looking at a mortgage or, a house payment, I always try to go with fixed because it means that I can plan on something. I can actually make a plan. And so, again, private education loans offer fixed rates. Some offer variable. Pick what's right for you and your family. But then you're looking at, the loan fees. So a lot of private education lenders, have less fees than what our Plus loan has. The Plus loan has about a 4% fee. I mentioned the 1% on sub and unsub. The Plus loan has a little over a 4% fee. So that's a pretty substantial fee as you're trying to plan out how much is going to be subtracted off of your total amount. So when looking at, the comparison between Plus and private, that fee differential is a big one. And then, that credit worthiness is a big one to make sure that you aren't being burdened with something that, isn't something you can pay back. There's a lot of different payment options as far as repayment is concerned. So that's something, again, looking at one versus another. The federal government right now has a lot more repayment options than a lot of private lenders. That being said, federal government is prone to change things, and there's a lot of stuff that's up for debate right now in Congress as they're putting forth their bills. And so that's something to kind of watch over the next 3 to 6 months as things kind of shake out there.
Definitely.
But those are all kind of things that to kind of look at and I guess educate yourself on. And if you want a more in-depth kind of look at what the difference between Plus and private, we do have our webinar series, and we'd love to see you check that out.
Yeah, that would be PHEAA.org/virtual.
I'm glad you said that.
PHEAA.org/virtual. Yeah, you can see all of our webinars out there. All of the Access Partner Team webinars are out there
Yeah.
too. So join us for those. But yeah, you get on the topic of fixed versus variable rate loans. I'll tell you just how old the old guy is here. When I graduated college, prime was about 21%. So I know where interest rates can go. And as a result, yeah, fixed rates just feel comfy and fuzzy and warm to me. I want to lock
I
it
agree.
in. I want to know what it is, because yeah, sometimes the interest rates go down, but I'd
Mhm.
say they go up more often than down. Right.
I agree with both of you. I think you guys made a great point. Fix, you can work with fix, you can budget off of fix, you know what it's gonna look like. Another thing I think a lot of families, they kind of say, hey, they see the variable rate and they're like, oh,
Mhm.
but it's as low as this right now.
Right.
And my reminder is, but how high can it go? What's the cap? Like you have to
Yeah.
think it can go a lot higher, and the
Mhm.
chances are it's going to go a lot higher. And I think sometimes also folks will say, with some lenders that are out there, they'll say, hey, they'll go and they'll look at what they have and they'll see an interest rate saying, hey, interest rate starting at this, they automatically assume that they're going to get that low rate. And
Yeah.
starting at does not mean that's what you are going to get. So for me, I always
Yeah,
say
that's
read the
true.
fine print, understand the terms, understand the conditions, and also know where you stand, with your own credit, strength. What's your financial credit strength look like? Because when they're pulling it, if you really, if you had some blemishes that are out there, you may not get that lower rate, because they're going to be looking. They may be looking at your FICO score. They may be looking at your debt to income ratio. So I think all of those things can play a part.
Mm.
And again, like you
Yeah.
said, for me, give me fixed. I know what I'm working with and go from there. But
Yeah. Some of the people who look at the variable rates, they might be able to get that lower variable rate. And I would always say you got to have in your hip pocket the idea that if something goes south on you, that you have enough maybe to either pay that off or get into a new loan vehicle. You just have to be more nimble, I guess, if you're going to go after
right,
that variable rate.
right.
It might not be a super long term 10-year, 15-year strategy that might work out for you. To me, I mean, that's the Dan Ray talking, variable rate loans, more of a short term thing or something that I have to be ready to make changes if I need to, so I don't get harmed by big increases in that. So, yeah, there's a lot when you're coming into the higher education years. Now is the time to get out on annualcreditreport.com and find out what is on your credit history.
Mhm.
Now is the time to, I don't know, I don't get paid to say this, but I pay a little bit of money every month to Experian. I'm sure TransUnion and Equifax and maybe others have the same types of features, but I pay a little bit of money every month just so I can see, like anytime I want, I can see what my credit score is at all three of the prime bureaus. I can see my credit history, see if anything's out there that shouldn't be out there. I can freeze my credit history so that nobody's out there trying to fool around with my credit and put me in a bad situation. The last thing you want to be is at bill time, and then you find out you need a private loan, and oh, by the way, what happened? Why is my credit score so low? That's not the time to be thinking about that. You got to plan ahead and make sure your credit's in good shape coming into higher education.
Totally agree with you on that. The other part, so now we're at that point where hopefully everybody's done their research, they are knowing where they're staying. A question I get all the time, and I'm sure you all do as well, is, well, when should you actually start the application process? The bill's coming, haven't gotten the bill yet. Should you start researching like in May, June? What's prime time to actually start to apply?
Well, the lenders are going to start bugging you in February.
Okay.
Just so you know, there's a lot of lenders out there that are going to try. See, they want to get their foot in the door as quick as possible because a lot of private lenders, the credit checks are good for 180 days, and so schools start certifying private loans in the June, July, August type of time frame. So you can see how, try to get inside the minds of lenders there, right? They're going to, about 6 months out, they're going to try to get you to apply, be approved, lock in, and then most likely you're going to hold on to that loan and they have you then as a customer, right? So be looking for advertisements for traditional, fall, spring, summer type of an academic pattern. So what I would say right now, we don't just do these podcasts in a vacuum. Uh, right now is sort of prime time for people who are applying for private loans. Right now is when a lot of people, they've done their calculations, they're looking at the numbers, they're realizing that they're going to need a private loan for sure. They might have had an inkling before. Now they're fairly sure they're going to need a private loan. So right about now is when a lot of people are filing those things. How did you work it in when I mean, you served a lot of years as director of financial aid, Will. So
Yeah.
so
So because people are starting at different times. So in general, for your standard school, May, June would be a great time. But really 2 to 3 months before the start of the term that you're going to be starting in. So the 2 to 3 months before the start of your term. Now, not everyone's going to have a bill out at that point in time. And so that's something that you're going to have to kind of navigate. Now, schools, as long as you filed a FAFSA, they're required to send you an offer letter. So using that offer letter, you can get an estimate of what your bottom line is going to end up being, and then you can end up borrowing that difference or whatever you're going to end up needing at that point. So, if you get your offer letter in April and you want to start shopping around in May, start putting out applications for your loans, May, June timeframe, you can usually get a pretty good idea of what your bottom line and what your out-of-pocket costs will be, so you can end up getting that number. I always end up saying, give a little bit of cushion just in case there's book expenses that you weren't expecting, or there's some sort of additional fee that wasn't on their offer letter. So, give an extra 2 or 3% that you can kind of throw out there as a cushion. But yeah, I would definitely say the May, June kind of time frame for most people is going to be your best bet if you're a fall start.
that's
And
great
again,
advice there to
yeah,
put a little cushion in there, because it's easier with private loans, right? With most lenders, it's easier to send some money back or have your school certify a little bit less than it is to get more. Sometimes you have to reapply. Might be another
yeah.
credit check going on there.
Yep,
So
sounds
great.
good. So you kind of was I'm sorry, Dan, were you gonna add on to that?
Nope, nope. Go
Okay.
ahead.
You kind of already pretty much addressed it, but it's kind of like the question always is, well, exactly how much do I have to have an exact amount? And so no, like you said, there's some cushion that is in there. And I think what's also important is what Dan said. There's a reminder that, if you didn't need as much, send it back. So I don't know if everyone got that
Right.
clear message. He was like, you can always send it back. That is my recommendation. If it's a student loan and you did not need as much as you received, you can always
Yeah.
take the excess and repay it, send it back, reduce it, and don't just keep it and just spend it on I think we talked about it before on. Don't take that awesome spring break vacation or anything like that. Put it back because it's going to save you in the long run.
Yeah,
It's going to
you
be
do
less
have
that
to
you have
watch
to
that
repay.
requested amount though, because part of a private lender's decision making is what's called a debt to income ratio analysis. They're going to look at your monthly debts versus your monthly gross income. And factored into the debts part is the expected payment on the loan you're applying for. So what we see happen sometimes is people will put this big number out there. Yeah, because when the lender is processing your loan and doing the underwriting, we don't know what your cost of attendance is at the school. School hasn't certified the loan yet. So if you ask for $100,000, we're going to do the credit check based on $100,000. That's so you might get denied because of that, depending upon your income level. Whereas if you had asked for a more reasonable number, 25 grand, 30 grand, or less, whatever you think you're going to need, do the calculations, you might have got approved. So
Yeah.
Yeah.
you do have
The-
to, there's
yeah.
a little bit of decision making to
The
do
other
that.
important thing to remember is that these loans are annual loans. This is not for all 4 years. So sometimes people get in the trap of I want to borrow, private education loans. I want to use this lender. I want to borrow for all 4 years. That's not able to be done. So the federal government puts certain caps and restrictions on what a school can actually process at a time. And so it has to fit within what they call their cost of attendance, which has the charges that are charged by the university or college, as well as some incidental costs that are not charged by the university, but kind of go along with attending a school. And so that's what, like if the plus loan is held within those cap, our private education loans, a majority of them are held within that cap. And so that's one of those things where, that's the gap you're playing with. You can't take that gap and multiply it by 4 and apply for an amount for all 4 years in 1 year. It's the federal government does not allow that. So that's just something to keep in mind as you're putting that number in there, because some people might apply for 100 thinking, oh, it's 25 each year, but you can't do that. That's just not something that is allowed.
Right. And then when we're talking about lenders, there's a lot of different lenders that are out there. So you all talked about there's the federal student loan program, your direct loans and your plus loans. So we already know who the lender is for that. It's the Department of Education. It's the federal government, right? Then we have these private lenders. So it's a lot of different private lenders that are out there. So if I'm the parent or I'm the student and I'm trying to figure it all out, any recommendations on what factors or criteria someone should use to find the best lender for themselves?
Yeah, we do a good presentation called Borrowing for Higher Education. So we'll be doing that sometime coming up here in the coming months. Check that out on PHEAA.org/virtual. But we have a slide that we're kind of proud of that has, I don't know, it's probably 17 or 18 different items to look at when you're looking for a private lender. It's important to pick a private lender who maybe has been in the business a while. They know what they're doing, and definitely interest rates and fees have a big factor to play in there. Some schools will use a product called either Elm Select or Fast Choice, and check out the financial aid web page for the school that you're going to. Some of them post the lenders that they've worked with in the past. Some of them post it right on their website. Others will link you out to Elm Select or Fast Choice, where those sites allow you to do some pretty good, hey, I want to compare this one, this one, this one, and this one, and then it'll help you do a comparison on features and interest rates and fees. So those comparison tools are extremely helpful. There's other ways also of comparing. What are some of your recommendations there? Well, I like Elm Select and Fast Choice, but I know there's other stuff there.
Yeah, so I think it kind of depends on where you are in your journey. So there are certain certain benefits when you're looking at as an incoming student. You're looking at how much can I borrow in a given year. Some lenders put caps on that. Some allow you to go up to the full cost of attendance. Some lenders have fees, some don't. So again, I always try to lean towards either low or no fees. You mentioned the loan rates. That's one of those things where if you can end up figuring out approximately what your loan rate would be, and again, don't factor in, what, just the very bottom. I mean, you can definitely, if you have great credit history and you have a long credit history, that's something that, or maybe you can, but I usually say, as a director of financial aid, I would say, all right, assume that a majority of people get somewhere in the middle. Because with most ranges you have a bell curve. Most people end up falling somewhere in that middle. So if you look at the middle between your high and low, that's usually probably where you're going to end up finding out where most people fall. And then look at the different repayment options. So when looking at most private lenders have 5, 10, 15 years as far as the actual repayment period. And so that's going to be pretty standard. And generally speaking, the further out you go as far as repayment, the higher your interest rate's going to be. That's in most cases, as far as you're picking your term. But it's just like looking at a mortgage. So if you go with a 15-year versus a 30-year, you're typically going to get slightly lower rates. But that's something just kind of shop around and see what they offer. And then, some different lenders offer different benefits. So if you're a student that's attending and, you had to withdraw due to family reasons or something like that, and you have a past due balance, you may be
Oh, have a little connection issue out there in Ohio. That's where,
Looking for a balance. You're trying to work and uh, both- yeah, both work and go to school.
no.
Well, I
Yeah.
think you're
Freezing
chopping up
over.
on us a little bit.
Mhm.
So I'll let Dan, I think I think where he was going was kind of saying like looking at the different options, looking at the different choices, and
Yeah, there's a lot to think about. There really is, but we've tried to simplify it here at PHEAA. You know, not to toot our own horns at all here. We don't want to break our arms off patting ourselves on the back here, but we feel like we've put together some very good loan programs here with PA Forward, which is really focused on Pennsylvania residents going to school anywhere,
Mhm.
or border state residents going to school in Pennsylvania. And then the Keystone program is for our border state residents going to school anywhere else but Pennsylvania. If they're going to school in Pennsylvania, they get PA Forward. But let's say Ohio resident going to school in Iowa, they can get a Keystone loan. So with our loans, we feel like we've put together some great options. Keep us in the mix if you're comparing loans. There's some big private loan providers out there. Just keep us in the mix as a comparison, because you might find that when it comes to loan products, an agency like PHEAA, state agency, we're only allowed to make a certain amount of money on these ones, and what we make goes back into public service benefits. And so you might find, well, let's just take a look. Depending on whose numbers you believe, the average private loan interest rate nationwide is pushing nine, depends on the number, 9 to 10%, something like that, whereas our portfolio average is 6.4, so with no fees. And in other words, we might be your best deal, we might not be. Chances are, so we are, but look around, do your comparisons, do your homework, and you might find that a lender such as PHEAA is going to be your best deal.
let me also back up just a little bit to talk about PA Forward. So PA Forward's kind of like a whole suite of, it's not just one loan. So kind of like break out the different types of loans that we have. I know we have some for students, sort of like a parent, if you guys want to just kind of say, hey, this is what we have. And then again, for Keystone, if it's different or if it's the same, for those students outside of PA, I think it's a great time. They're good, solid products. I don't say it. No one's paying me to say this as well, but I do believe they're good, solid products. So I want everyone to have a full understanding of the basics, and they can get all the intricate details about the loan programs, on our website, and we'll talk about that. But you can kind of just let them know what types of loans are available through PA Forward and Keystone.
I'll just give the big overview there, that the only difference really between PA Forward and Keystone is the residency requirement on that, and the fact that we have a tax exempt allocation here in Pennsylvania that enables us to give slightly lower interest rates for PA Forward than for Keystone. Just other than that, all the features of the loans are the same. But in terms of student versus parent versus refi, I'll let Will cover the differences in those programs.
Yeah, so we have one of our loan programs is our undergraduate, standard student loan, and we also have a graduate student loan. So those are going to be in the student's name, potentially with a cosigner. Cosigner is not required, but that is something that if the student needs one, and I would say this, a majority of your traditional students end up needing, particularly on the undergraduate level, end up needing a cosigner. And that's okay. But looking at the graduates, if you've been out in the workforce for a little bit and you have a stronger credit history, or an adult student kind of going back and getting an advanced degree, that's something where you might not need a cosigner. You can end up utilizing that. But for those undergraduate students that their parent does not want them to have their own loan, we do have a parent loan option. And so that is something that would be in the parent's name for a student. And so that's, again, it just depends on who owns the loan. And so, when looking at, again, what's best for you and your family, that's up to you guys. But, something else to kind of consider is, our refinance loan. We actually have a refinance loan. So if you end up having multiple loans and you want to consolidate that into one payment, you can end up utilizing that as well. Honestly, as you kind of mentioned, I honestly feel we have really good products. This is something that, coming from a financial aid office, getting to experience the breadth of everything. When I was shopping around and looking at the different loan products and things that are out there, I saw this one. I was like, that's something I could actually give to my kid. My boys that are going to need to borrow a little bit, like this is one that I could get behind. And so, luckily I've been able to be working here for a little while now. And the more I get into it, the more I'm more and more pleased and feel blessed to be part of this program and these products. So,
Yeah.
yeah, Dan.
Yeah, one thing I would point out regarding our graduate loan program, because some lenders have a graduate loan for med students, for dental students, for whatever, MBA students. Our grad loan, the only difference between our undergrad and our grad loan is the aggregate maximum. We allow, just like what the federal government does, we allow graduate students to borrow more than undergraduate students. That's really the only difference. And with our graduate loan program, you can use that for any graduate level program, MBA, medical, dental. So there's no confusion there. There's nothing to figure out. If you need a graduate loan, you get your Keystone graduate loan or you get your PA Forward graduate loan. We try to
Yeah,
make this
because
very simple for people.
Yeah, it's graduate and professional degrees. That's it's all encompassing. Whereas, again, some lenders have a very specific focus, on graduate or professional degrees, but that's something that we decided to be broad spectrum on that.
Good to know. So for all of our listeners who want to know the specifics about Keystone, about PA Forward, terms, conditions, and all of that good stuff, how do they find it?
Oh yeah, just PHEAA.org. You can go right to the homepage, and we're just one click away, right there on the main homepage, PHEAA.org, PHEAA.org, and you'll be able to find your way to both programs. So when it comes to applying for the loan, you apply in the same place, apply.PHEAA.org, and then we will ask you the questions. We'll get, are you a resident of Pennsylvania? If no, are you a resident of New York, New Jersey, and we'll name all these states around there. If yes, then we just lead you down the path. And at the end of the questions on the first page of the application, we'll just put that right up on the screen for you. Congratulations, you're eligible for, and you'll either say PA Forward or Keystone. We're just going to lead you through the question and answer there pretty quickly, get you into the right program, and then you can go on with the application. We try to make it very simple. It's online. It's all very, what the old guy calls pointy clicky. It's very pointy clicky.
Yeah, you can end up submitting all your documentation on the site as well. So again, it's a one-stop shop as far as what you're going to need to do as far as your application.
And how long does that application process take generally, from beginning to end? I started the application process, and of course, I know it can vary with school certifying and things like that, but on average, how long should we say someone can expect to wait to hear back?
I liked Will's advice earlier. 1 to 2 months, definitely to do that application. Now, look, if everything goes with no hitch whatsoever, you get in there, you upload all of your financial documents. We're going to do the credit check within a couple of days' time. In our busy season, it might be a week in order to get the credit check done. Then we're going to queue that up to the school to certify the loan. Sometimes schools are, they're very busy in the summertime. It might take them a while to get to certifying, or they might just have a cutoff time. Like, we don't certify private loans until August 1st or whatever. They might have that criteria. So, but if everything goes exactly perfectly, there is still a 3-day rescission period, just like with any other loan, where we have to give you time to say, hold it, I don't really want that loan. Let's cancel it. So there's still that. And then there's the disbursement process. Most schools do electronic disbursement, some want paper checks. But all in all, if everything went absolutely perfectly, it would probably still take almost 2 weeks to get money to the school. That's why we recommend that
Yeah.
1 to 2 month or more, lead time.
So you'll talk with a lot of schools and they'll tell you, the 2 to 3 weeks as far as a good time frame. You'll also hear schools tell you about a month as far as getting it in. So, again, if you're doing it in a non-peak season, so not summer, not around the change of semesters, if you're doing it, a few weeks into the semester, or you're a little bit behind, something like that, it can get pushed through pretty quick. And again, that pretty quick is 2 to 3 weeks. But if you're looking for, in peak season, plan ahead, start applying now, start getting the process going now, so you can have everything ready before the start of the semester.
Yeah, and there's some interest rate gamesmanship that can go on there too. Because if you're looking at a lender who is basing their interest rate on prime, I know that there's some people who are out there and they get on a site like bankrate.com or some of the other great financial sites, and they'll be watching prime. Is prime trending up? Is it prime trending down? If it's trending down, then a lot of folks are just they're gonna wait, and apply as late as they can to try to nail that lowest possible interest rate. Of course, it's also going to be based on your credit score and your debt to income ratio. But if it's a prime based loan, that's another way that we take some of the unknown out of the process here at PHEAA. We aren't just fully based on prime or LIBOR, the London Interbank offering rate. We're not fully based on any of that stuff. We try to make our interest rates good for longer periods of time than some of the other lenders do, and take some of that volatility out of the marketplace due to our funding sources. But there is some interest rate gamesmanship that some people will want to look into as well. So yeah, you can see there's a lot to think about when it comes to this. And so some of the moral of the story here today is we like to see people go into your financial aid nights, Tiff, and
Yes.
and listening into our webinars and hearing it over and over again and planning in advance, because when you get to this point in the game, May, June, July, and your student is starting school here in just a couple of months, man, there's an awful lot of decisions to make. And if you've done some of that ahead of time, man, you're way ahead of the game.
I think you summed that up really well. So it's kind of like saying, hopefully they were listening to us when we were doing our presentations and the webinars, and here's the time. They're at the time now where they kind of have to like put into play and practice what we were preaching,
Yeah, this is when it gets really serious. For
Yeah.
anybody who's helped to put kids, I say kids, because I'm old, but helped to put students through post-secondary school. This is about the time of year when, man, it's just, you start to break out in that cold sweat, like this. Okay, we talked about all this stuff. We did our FAFSA and stuff, and it was all fun and games back then. But right now, it's starting to feel a little bit too real. You want how much money by when, in the school. So, yeah, now is the time. Hopefully you've done a lot of work in advance, and that can help take away some of that panicked feeling. I laugh. I mean, what else can you do? I mean, but try to laugh, because
and you're an expert on it because you've gotten your kids through. Yeah, you've gotten all your kids successfully to their school. So I consider you a personal expert. Yeah, you got a whole 5 sets of degrees.
But when I was I had years of experience in this before my kids started going to post-secondary school, and there were still many times I would look over at my wife, at the dinner table and say, Vic, I'm really kind of embarrassed right now because I'm confused. Why? How can I possibly be confused? I've worked in the financial aid office. I've worked for lenders. It looks different from that.
From the other side. Yeah.
And it's complicated. There's no way around it. But
so we'll keep that in mind when it's your turn. It may look different from the other side, but give Dan a call. He'll walk you through it.
That's it. I've got about a year. I've got about a year before I'm in this book.
Well, one thing's for sure, certain. I know anyone who's tuning in, they've gotten a great deal of information from you guys just regarding student loans in general, the different types, specifically also on our PA Forward and our Keystone loan programs. Again, I do think they are solid programs. I encourage everyone, don't just take my advice, do the research, go to our website, PHEAA.org, tap into our webinars via PHEAA.org/virtual. Like you said, Dan and Will, there are lots of webinars that you all have done, not just on PA Forward, not just on student loans, but just about the whole financial aid process, as well as my team with the Access Partner. So I think if our listeners are tuning in and they want more information, I think most of their questions will be answered. If not, they know how to reach us as well. All of our contact information is out there. Any parting words from either of you, or anything that you wanted to share that maybe you don't feel like we've done?
My parting words, anytime we talk about loans, and Will touched on it at the very beginning, is, return on investment. You got to look at higher education as an investment. And it's one of the best investments that you can make, financially speaking. But you got to do it right. And doing it right means obeying the rule of thumb. And Will mentioned it. Don't borrow more than your projected starting salary. And as long as you stay within that guideline, we can't emphasize that enough. If you look at our webinars, we're going to put up a big red stop sign 2 or 3 times, and it says don't borrow more than your starting salary. That's really the key. As long as you stay within that guideline, you're going to be looking at higher education as being a very big return on investment. You might borrow, who knows what, you might borrow $100,000. But in the span of your life, you might make an extra $1 million to $2 million. So that is a pretty good investment if you do it right. That'd be my parting shot.
Yeah. Yeah, and to look kind of at that exact same thing, there is a website that's out there. It's a free tool to see how college and career choices can affect your financial future, and that's mysmartborrowing.org. So as you're kind of looking down that path and figure out, is this the appropriate amount? How much can I actually borrow and still, do it wisely? mysmartborrowing.org is a great resource for that. And then, we actually have on our PHEAA.org webpage, there's a financial aid toolkit that's available for people to get out there and kind of look through some of the different digital offerings as far as, tips and tricks to end up tracking different things and utilizing those different resources to help with the entire financial aid process. So, your team's a great resource. We have online resources. There's a lot of different things that are out there. And this can be a tricky time. Sometimes it's like speaking a foreign language, with all the different acronyms and different things that are going on. But we try to make it as simple as possible and give you as many resources as we can to make the transition smoothly from high school to secondary education, post-secondary education.
That's a great point.
And I think you guys both do a great job of doing that. So once again, thank you both for joining me here today at the Higher Education Access Corner. Again, for our listeners, PHEAA.org is where you'll get all of the additional details regarding our student loan programs and just financial aid in general. So once again, I want to say thank you all for listening, and I'll see you soon.
Thanks, Steph.
Thank you.